Chainlink just entered another live institutional financial workflow. Lombard launched a Bitcoin-backed credit strategy with Flow Traders as its first institutional borrower. Chainlink is part of the operating infrastructure behind that strategy. That is real usage, not a test announcement, not a future integration. A functioning credit product involving a publicly listed trading firm. But Link still rallied into the high $8 range and surrendered the move. Chainlink keeps proving its infrastructure can be used, though. The market is still waiting to see what that use is worth. Today is July 29th, 2026. Another live workflow suggests that Chainlink's production footprint is expanding across different parts of finance. But the public disclosures do not tell us how much capital has entered the strategy, how much volume Chainlink is processing, or whether the workflow is creating material demand for Link. The infrastructure story continues to advance. The economic evidence still has to catch up. Link entered the reporting window near $8.63. Price weakened through the middle of the week before recovering sharply on July 26th. That recovery continued into July 27th when Link challenged approximately $8.90. It did not, however, sustain the move. By July 28th, Link had fallen back near $8.32, surrendering the advance and ending the period below where it began. That gives us a straightforward structure. The region between roughly $8.25 and $8.35 is the immediate support zone. That area absorbed the latest reversal and now protects the remaining recovery. The high $8 range remains resistance. Link has approached that region more than once without establishing acceptance above it. A brief move through $8.80 or $8.90 would not confirm expansion. Link needs to reclaim the area, hold it, and then establish itself above $9. That would show the market assigning a larger premium to Chainlink's growing production footprint. A decisive loss of the $8.25 region would do the opposite. It would suggest that the latest institutional development was not enough to protect the recovery from broader selling pressure. We cannot prove that Link reversed because investors rejected the Lombard news. Broader crypto weakness, profit-taking, macro positioning, and altcoin liquidity may all have contributed. What we can say is simpler. Chainlink added another live use case. Link still failed to sustain expansion. The Lombard strategy gives us a useful view of how capital is expected to move through the product. Bitcoin holders deposit collateral through Lombard. Flow traders borrow stablecoins against the strategy for market-making activity. The borrower pays a fixed premium. That premium is collected into USDC, converted into LBTC, and compounded for depositors. Chainlink CCIP supports cross-chain deposit access, including movement from Avalanche into the Ethereum-based credit vault. Chainlink price feeds also support parts of the product's risk infrastructure. That is a functioning economic design. But the design and the scale are not the same thing. Public disclosures do not currently provide the total amount deposited, the amount flow traders have borrowed, the volume passing through CCIP, the fees paid to Chainlink, or the amount of Link demand created by the workflow. This is the important distinction. The strategy contains real economics, Its contribution to Chainlink's economics remains undisclosed. We also do not have reliable fresh evidence this week showing major link exchange withdrawals, new whale accumulation, or a significant change in staking. Older accumulation figures are still circulating, but they should not be treated as new positioning data. So the flow picture remains incomplete. The product is live, its scale remains unknown. Flow Traders gives the Lombard launch institutional credibility. It is a publicly listed global trading firm operating across traditional and digital markets. Its participation shows that the strategy was built for a real institutional borrower rather than a demonstration environment. But Flow Traders is also the only borrower identified at launch. One credible participant proves the institutional usage has begun inside this specific workflow. It does not prove broad adoption. Chainlink's role also needs to remain precise. CCIP supports the deposit infrastructure. Chainlink data services contribute to the risk architecture. CAP protocol manages the credit line. Symbiotic provides the collateral vault. Lombard coordinates the strategy and depositor experience. The arrangement also includes a bilateral legal agreement between Lombard and Flow Traders. Chainlink is an important component. It does not power every part of the product. That makes the development more credible, not less. Institutional financial systems will rarely depend on one provider for every function. They will combine custody, credit, messaging, collateral, data, compliance, and interoperability across multiple platforms. Chainlink's opportunity is to be the trusted coordination layer connecting those systems. Project Pangaea remains a long-term institutional model combining Swift messaging, regulated stablecoins, and Chainlink orchestration. This week guided discussion, not production. Lombard is the current operating evidence. Pangaea remains the larger institutional possibility. The most important technology development is Chainlink's transition from automation version 2.1 into the Chainlink runtime environment. Automation version 2.1 is scheduled to sunset on July 31st. Users have been instructed to migrate their existing upkeeps to CRE to avoid disruption. That tells us Chainlink is consolidating more of its infrastructure around a broader runtime architecture. CRE is designed to coordinate complex workflows involving blockchains, external data, private systems, compliance rules, and institutional infrastructure. It is strategically important. It also creates execution risk. A forced migration carries execution risk and may create developer friction. Applications that fail to migrate may experience interruptions, and we do not yet know how many users have completed the transition successfully. The move should not be treated as automatically bullish. It is a major architectural step that still has to prove reliability in production. Chainlink also expanded data feeds to Tempo mainnet and added 3 assets to the cross-chain token standard. Those developments show continued ecosystem expansion. They do not yet establish meaningful usage, value secured, service revenue, or link demand. That distinction reflects the broader shift in market sentiment. Integration counts are no longer enough. The market increasingly wants evidence of repeated transactions, growing volume, service fees, additional institutional users, and visible economic demand connected to Link. Chainlink has already established infrastructure relevance. The next question is scale. Chainlink now needs to prove that live production can become measurable economics. The first confirmation will come from the Lombard strategy itself. Watch for disclosed deposits, stablecoin borrowing, additional institutional borrowers, and continued activity through the credit vault. Flow Traders proves the product can attract one credible borrower. A second or third borrower would begin to show repeatability. The second confirmation comes from Chainlink service usage. CCIP volume, data service activity, fees, and revenue connected to the strategy would tell us whether the workflow is economically meaningful for Chainlink, rather than merely operationally relevant. Chainlink's payment abstraction system and reserve create a potential path from service revenue into link accumulation. But the pathway only matters when the underlying revenue becomes large enough to measure. The third confirmation comes from CRE. The automation migration needs to conclude without widespread disruption. Successful migration would support Chainlink's effort to consolidate complex workflows around one runtime environment. Persistence outages, failed migrations, or developer resistance would weaken that argument. The fourth confirmation comes from price. Link needs to defend approximately $8.25 to $8.35 and reclaim the high $8 range. A sustained move above $9, supported by stronger volume, would begin to convert the current recovery into expansion. A loss of support would show that infrastructure progress is still not producing enough market demand to protect price. So the next stage is not about collecting more integration announcements. It is, however, about proving scale. More capital, more borrowers, more transactions, more fees, and a clearer connection between Chainlink usage and link demand. Chainlink keeps proving its infrastructure can be used. The market is still waiting to see what that use is worth. Understanding Chainlink requires more than counting integrations or following Link's price. You need to understand how infrastructure usage, institutional adoption, service revenue, token demand, and market structure connect. That's exactly the framework I break down in Understanding Crypto, a clear guide for new investors. I'll put a link in the description. Chainlink has entered another live institutional workflow. Now it has to prove that production become measurable economics. Tell me what matters most from here. Additional institutional borrowers, disclosed Chainlink activity, the CRE migration, or Link reclaiming $9. Leave me a comment and subscribe to CoinOps for the institutional developments shaping crypto before the price catches up. Stay locked.